Hi guys, welcome to a new video. Today I'm going to be discussing leveraged and inverse ETFs. The reason being is I got a comment yesterday on one of my videos asking about them. You can see it just here. Can you explain for me why 3 times short Rolls-Royce fund still goes down even though Rolls-Royce shares have dropped 60%? And the other thing is, this was on the Rolls-Royce video that I did. And the other reason is because the SEC yesterday came out and announced that they were no longer going to seek changes with the way leveraged ETFs work, which has sparked concern. The reason being they were looking into this. Obviously, leveraged ETFs have been around for 16 years now. Sorry, 14 years now, since around 2006. So they've got more complicated. There are lots of different ones now. As you saw there, you can do things for individual stocks. You know, a 3 times short fund for Rolls-Royce, a 3 times long or short for S&P, that kind of thing. It gets more complex. And the way these work, I'm going to try and explain it. The way these work is that they take the amount invested. So say I invest £100 in a 2 times levered S&P ETF. They take that £1 and they use derivative contracts to gain £2 worth of exposure. They're not buying the underlying asset. So they don't take £1 and buy £2 worth of money. Worth of S&P, because obviously they don't have the cash for that. Instead, it's a complex derivative that acts like the investment on each given day. And that also means that these funds often hold cash within them to cover any exposure if things go wrong, if the asset loses money on a given day. So, because of the complexity of these products, they rebalance daily. You can't have exposure beyond the amount you have. So, I mean, if I try and explain it to you, say the fund has 100 million assets, 100 million invested with them. They have exposure of 200 million if they're 2 times levered, 300 million, etc., etc. When it comes to it, and in a day, the asset itself rallies 1%. That's an extra 2 million in assets the fund now has. So, because it's 2 times leverage ETF, obviously you get a 2% gain instead of 1. So it's a 2% gain on 100, so it's 102 million. You've still got you've now got 102 million, but you've only got 200 million exposure. That means you've now got less than 2 times leverage. So these products have to rebalance every day to retain that leverage, to ensure that they're staying at that level. That's just as true when they lose money. When they lose money, they have to reduce their exposure because their assets have gone down, and they go down every day. That's why these products can be dangerous. US regulators kicked up a lot of fuss about them because they are strange in how they operate, because these products can go to zero. The more leverage you put in, the quicker they can go to zero. And people don't tend to really understand that when they invest in them. I myself have used leveraged ETFs before earlier in this year. I knew what I was using, but even I didn't use them how they were technically supposed to be. So you're supposed to use these kind of funds for very short time periods. I think I held them for about 3 weeks, and that isn't their purpose. Because of their daily rebalancing, you're supposed to sell out and hold them for very short periods of time, for a day, for a very small period, not for weeks, certainly not for months. Unfortunately, data shows that a lot of people do use them for longer than they should. As I'm one of those examples, and it went well for me before fees, but it could have gone badly in another example. So while I enjoy using those products, and I use them because at the time I had a small amount of capital to invest, and I wanted to maximize my return on that amount, and a leveraged ETF was a good way of doing it. I'm not advising you do that at all. In fact, to be honest, I would probably stay away from these products. you can make money on them, but you can also lose a lot of money, and you're not gaining much by using them. The additional leverage is obviously more profit for you, but you can equally go to zero in a very small space of time, and that's not what you want. Certainly, that's not the kind of investing I'm advertising. When I put that position on, I was looking for that quick profit. I was just testing an idea. My position was very small. I was fairly confident it would work. This was all back when coronavirus first hit. I effectively bought the first dip and rode it back up, virtually at the bottom, which was pure luck. Again, do not time markets. Do not try and time markets. To be honest, more than anything, it was me trying to learn for myself. Obviously, I know the investing ethos, I know the words. Don't time the market, don't buy, try and pick the bottom, but sometimes it's fun. When you're using small amounts of money, I want to reinforce that. And when you're just testing, you're having a go at things. Even with leveraged ETFs, it's nice to explore, to try them out and see how they work. And that was good for me. Obviously, I actually got caught up in the fees to buy in and out that were more than a normal trade. And because I hadn't put much money in, that completely decimated my return, despite the fact that it was, I think, about 40%. So that wasn't ideal, but the theory worked. But anyway, enough of that. Let me explain why they're not necessarily the best idea for most people. So as I said, they rebalance every day. That means if we look at this chart from Investopedia, from an Investopedia article which goes into detail about leveraged ETFs, I'll link it in the description for those interested. You can see here this is an example that shows an index, an underlying asset, and then the ETF that's 2 times leveraged. Let's say the index loses 1% a day, 4 days in a row. The ETF loses 2% a day. The Friday then, the index gains 4.1%. The ETF then gains 8%. Well, look, the index is back up at 100. The ETF is not. The reason for that is that daily rebalancing, which reduces or increases, depending on whether it's profiting on losing each day, the underlying assets. So, when you lose that, you're losing 2% of the daily assets every day. So you need to earn more than that 8% back to recoup it to the full amount. That's how you can lose money, even if the stock's gone up or gone down or gone whichever way you want to in that period. You can still lose money because if it's a volatile stock, the swings can really kill you because it's daily rebalancing. With the Rolls-Royce example from the guy's comment, if you had sold Rolls-Royce and held, you would have made money. But if you'd used the triple lever fund, you could have lost money because of the way that works. Because you can lose out in big swings, which you don't get when you're buying and holding or selling and holding. Obviously, selling is quite difficult as a retail investor. There are other risks associated with it. In some ways, these leverage funds, these invest funds are better for that. On that note, let's jump into invest funds because this is also part of this story. Invest funds are effectively products that let you short a company, a market. They don't do it by selling the underlying asset. They again do it through derivatives, which is why this is, again, a daily rebalancing fund. They're all like that. And they also all have the same issue of if they rebalance daily, it locks in the performance. Every day a change occurs, your assets are hit. Your investment is hit. Not like if you were buying and holding or selling and holding. So when you look at using these funds, even if it's not a leveraged invest fund, which also is a thing, you have to be careful. With all of these things as well, there are additional elements. They tend to have higher fees than normal ETFs, which obviously in the long term hurts a lot. They also tend to have higher transaction costs. Again, that's something that I experienced myself, which really destroyed any profit I had from the position. And that can really tear apart your profit. So what I'd say about this is that you can use them, and I've used them, so it'd be wrong for me to advocate that you don't. You can use them, but know what you're using. Know that they are products designed for very short holding periods, that they are complex products, that they will absorb the profit or loss every single day. And knowing that, if you still want to use them, go ahead. My advice would be keep your position small. I don't know about US wise, but there are limits on leverage in the UK. So UK ones don't go above, I think it's 5. And I wouldn't go above that. You don't want to be exposed to those kind of swings. I mean, put it this way, this week we've had in the stock market, you had a 4% down day in some European markets earlier in the week. If you'd been in a 4 times leveraged, 5 times leveraged ETF, your losses would have been massive. In a single day, you would have lost 20%. Now, if you'd been in a 10 times leveraged ETF, you would have lost 40%. So just bear that in mind. In a single day, in those kind of really leveraged funds, that is what you can lose. And that's why they're dangerous. And that's why there are people, in the US, in plenty of other places that hate these products. Think they shouldn't exist. I think they are against really consumers because they almost not prey, but they're designed for retail investors. Sophisticated investors don't have to use these products. They have access to the underlying derivatives themselves. So they're avoiding this kind of risk associated with it. And they have other ways to achieve these kind of things. So these are really designed for retail investors and take advantage of the fact that retail investors can't really go elsewhere, which is problematic at times. I think when you're looking at these funds, there is an argument that they are more gambling than investing. You are taking the money that you have, leveraging it, and going all in. Now, there are other ways to obtain leverage, using a mortgage, a loan, and then using that money to invest is probably a better alternative. I've seen investors advocate for that, especially if you're fully investing yourself, say it's your full-time job, you're investing in your own portfolio. I have seen people both advocate for that and do that very well. But again, there are additional risks with that. If it's leverage that you're after, this is a way to do it. Not necessarily the best way, the safest way, or the most logical way, but it is probably the easiest. As I said, I've used them, so I won't advocate against them, but I would advocate knowing what you're using, never going too big on a position, and really, if you're going to use them, test the water. Don't jump in. Hold them for a few days, see how it goes. I mean, you've seen from, the volatility we've had this week, it was a really big down day a few days ago. Now we've had a big up day in the US anyway. That would hurt these products. You're going to lose more than you gain in that case, and that's not what you want. The buy and hold in that strategy would be better. So yeah, I mean, part of this video has been a little bit rambly, but thank you very much for listening if you got all the way through. I just thought I'd take the time to try and explain that. I hope this video was helpful. I hope you enjoyed. Please like the video and subscribe, and thank you very much.